is part of their plan. But I've been 15 years in these markets, managing funds, various organizations. Like first was advisors, last 5 years at Bazaar Prudential. And I'm one of the senior fund managers for the PMS AIF. Without much ado, I'll just start off. Today I'll be sharing our next month. Instituting is a year of execution over narratives. The focus should be more on micro as compared to macro. But before we do that, let me first give you an idea of what happened in the last 1 year before we set the stage for what's likely for the next 1 year. Right? So, if you look at India performance in the last 1 year, as you can see from the slide here, India has almost given negligible returns. This is in dollar terms. This looks abysmal when you compare to what happened globally. Emerging markets have given almost 40% return, and even the global indices are up 20% on the average. Right? So while it looks like that India is not given a return, if you look at rupee returns for the large cap indices have been in the range of 78%. It was actually the rupee depreciation because of which, in dollar terms, the returns seems pretty low. When you further drill it down, the large caps and mid caps have 3.08% returns, small caps have almost given away. Right? So the underperformance that we are seeing here, it's not because India crashed or there was some 10-15% negative return. It was just that money moved globally. And there was a lot of FII selling that happened in India. So when you look at some of the numbers, there was one of the highest FII selling that we had in the Indian market in the last quarter. Almost $90 million of funds flew out. This was highest, second highest was $70 million, which was
That is good.
And why was this happening? This was because of a couple of reasons. Firstly, a lot of money was going into AI. Even if, when you look at the outperformance in some of the markets like Korea, Brazil, US, most of the money is actually going into the AI-related stocks, not so much in the non-AI. Further, what happened was that India looks unfavorable when it comes to the India-US trade deal, and US is an important trade partner. Almost 20% of the merchandise exports had to US. Because there was a lull and a delay in signing that deal, India in the global context looked pretty good. This was further compounded by the fact that there was rupee depreciation, and which eroded all the dollar returns of their clients when it came to investing in India. Right? So, but having said that, since last couple of weeks, after a long time since the signing of the UK FTA, EU deal, as well as the conversation starting to happen on India-US, we are again starting to see FIIs coming back to India, but we'll discuss them more later into the presentation. But before I get into how we're looking at the markets from here, let me spend some time on how India has done in the last decade. Right? This is what has India done in the last 1 year, which is broadly an underperformance. India remains relatively well positioned in the global scheme of things when it comes to investment. But before we understand the India story going forward, it's good to have the context of what happened in India in the last 20 years. So we've broken down the market into two phases, 2010 to 2020 and 2020 to 2025. You will see a very stark difference here. 2010 to 2020, there was a very narrow rally in the Indian markets. Right? The large cap maybe only a 5% return, but the sort of sectors which did well were more B2C, consumer-related sectors, more IT-related and power-related sectors. But a large part of the core industry for India actually struggled. Power, metals, textiles, a lot of these industries actually struggled, and for a good decade they were negative annualized returns. And the scenario has completely turned in the last 5 years when actually these sectors, the core industrial sectors, power, metals, these are the ones which are outperforming. Why has this happened? Right? It's important to have a context of this before we set into how we expecting the markets to be from here on. So if you remember last decade, somewhere in the middle, around 2014 was when the Modi government came to power. a lot of reforms were undertaken by the government. GST, demonetization, era. A lot of PSU match, which is almost 40% of the banking system, I think they are put under the PCA framework, which essentially meant that you had an NPL issue, almost 10-15% NPL, fixed NPL issue before you start lending. Right? This resulted in capital not flowing to the economy. Right? So, 2014, if you look at the dotted line, that's the average corporate profit to GDP, that average is 3.7. But when you look at 2014 to 19, that number was only coming down from 3.8% to 2.6%. Every year there was a decline, and it bottomed in 2020, which was also the COVID year at 2%. Right? So there was a lot of pain taken in those 5 to 6 years when a lot of structural reforms were happening in the economy. We saw consolidation across sectors, more on the core sectors, metals, cement, real estate. In real estate, for example, almost 60-70% of the developers have located in the market. Right? And a lot of these changes got accelerated during COVID, consolidation got accelerated, and from there we saw a very broad-based growth. In the next 5 years, we went on from 2% to 5% corporate profit to GDP. This was an era where most sectors were delivering 20 to 30% sort of return, and therefore this change in performance which we saw. So a stark difference prior to 2020, when it was B2C, consumer-facing businesses which were doing well, it actually turned where B2B started doing a lot better. And when you look at the chart on the right-hand side, you will see the dark, the black line which represents defensive sectors, which is consumer and IT. You're still doing fine. You're still growing at the same patch to GDP. But it was the defensive, which is the mustard line, where there was a big revival. It bottomed at 0.5% and it went all the way to 2.2%. Right? So from here, a large part of the beta rally is sort of done because a big normalization of earnings has happened. What I mean by normalization is that corporate profit to GDP is again back at 5.2%. The beta rally which happened from 5.2% meant that a lot of the sectors have broadly been discovered and multiples are no longer cheap as compared to what we got 3 to 4 years ago. Right? This chart also explains that beautifully. So if you look at 2015 to 2020, the chart on the left hand side is the GDP, the chart on the middle is the Nifty pack, and the chart on the right hand side is the market cap. Right? When you look at 2015 to 2020, the nominal GDP was 10%, and growth was only 1%. Corporate India growing only at 1%. Right? If you actually break it down, you will see B2C growing at 10%, but B2B businesses were actually degrowing. Right? Which was what I said that metals, power, a lot of these core sectors were actually struggling in India. Next 5 years, 2020 to 2024, same GDP, 10%, but the bank was 35%. This was the beta rally that we saw in India for 2 years, where a lot of small and mid caps gave 35% sort of return. Large caps during this time actually underperformed because they gave only a 10% return, which is generally the growth profile of large caps. So from here, when you look at the 15 years in total, right, 2010 to 2020 and 2025, nominal GDP 11% CAGR. When you look at the earnings, 11% CAGR. So big normalization in beta has come off, and from here, finding beta as well as alpha in the market becomes challenging. Right? What is the point that I'm trying to make? The point that I'm trying to make is that it's back to execution. One has to be very careful what kind of stocks one puts money behind it, not just putting money in equity markets, but having the right selection of sectors, of companies which actually have the ability to grow much faster than the industry, driven by strong economic growth, competitive edge, run by very well-run countries. They are the ones which will create. So in this overall 10% earnings growth which we are expecting from here, which should be in line with the GDP. There will obviously be companies which will be growing at 15 to 20%, but at the same time there will be companies which will be growing in single digits, 5 to 6%. So from here, the focus has to be on on backing the right kind of stocks, not just putting margin. Right? And therefore, for us, this is a year where the focus on micro will be a lot more than macro. And execution is what we are looking at. So where are the opportunities in the Indian market? Right? So India, as you all know, has a great demographic dividend. We have the fastest growing parents class. Between 2024 to 2030, we are expecting almost 14% figure in the affluent and the upper middle class. This is the fastest growth that any country will see over the next 5 to 6 years. Middle class and the lower middle class on the other end. And what that means is that categories which people at the higher end will consume, which could mean hospitality, aviation, it could mean financial products like asset management, wealth management. It means the onset of new kind of consumer services like payment with commerce in India. Everything that is consumed by people at the higher end, including high-end real estate, is the one where we should see a higher growth. Products or services which are consumed by people at the lower end, like such as FMCG, products, soaps, detergents, really everything that largely is done from here, that sector should be 5% growth. Right? So India, particularly at the middle and the higher end, will be growth. Now just come and look at how India is positioned from a balance sheet perspective and how the corporate sector is doing. So bottom-up, we are actually very well positioned. Current account deficit, fiscal deficit has been well under control. The current government has been very, very good when it comes to spending. Services exports have been growing in the range of 17 to 18%. Government, along with RBI, has been doing. So while in the 1 year we saw almost negligible dollar returns, what has been happening in India? Right, so RBI has actually given 125 basis point rate cut. To solve for the liquidity, they've given a 100 basis CRR cut. Government to solve for demand side, they've given a big GST booster. And this is a big booster for sectors such as autos, which form almost 40% of manufacturing in India. Right, so while globally when one looks at India, it feels like India is not doing anything. There's actually a lot happening on the ground, along with the fact that the fiscal and the current account is very, very strong. A lot of the spending during this time has been done by the government. When you look at, we've broken down the capex into center, state, as well as the private capex. Center and state have actually been emitted in last 5 years. When it comes to defense, railways, roads, a lot of spending has actually been done by the government. Private capex, which generally is much higher than central and state, has a big record. But government has been giving them a lot of scope. So, for example, there was a corporate tax rate which was brought down to 25% just before COVID. What this has done, coming to the head of the corporate area, as I showed you in the earlier slides, that corporate profit to GDP actually went back from 2% to 5%. Right? What that did was that investing cash flows are very, very strong. And along with that, the cash flows, which is the operating cash flows, the first bar inside are reduced by 18%. So the problems that India had in form of NPLs, in form of corporate balance sheets being stretched. Whenever there was a global event, you would see Indian corporates starting to fold up as well. There were a lot of pockets of excesses which were evident. But in the last 12 to 15 months, we actually seen a very, very resilient corporate return, which is also reflected in the debt to GDP, which is down 0.6 level, which means that corporate India is healthy, looking to grow. And along with the fact that we were just mentioning that government has been pushing private companies to start doing capex, that has finally started reflecting. And this year, after a long time, we are expecting this will be the first year where private capex will actually surpass government in both central and state capex. Right? Along with the fact, we have, recently we had the budget. There has been a political continuity in the form of infrastructure spending. There was some worry that it could be more populist, but the government has kept the focus of financial prudence and on spending for development in the form of PLI for electronics, in the form of more defense spending, in the form of more job creation. So government policy is a continuation and something that we were lacking the whole of last year, which was a global certainty that started to move with positive direction. We've signed the EU-India deal, and EU was a very important trade partner. This is something which has been in the making not for the last couple of years, but actually for the last 20 years, where EU was just dragging its feet to actually sign a favorable policy with India. And EU almost accounts for 18% of the merchandise exports. Almost $33 billion of exports. They're moving towards reducing taxation on all of them. Right? So while EU got concluded, in the first part, in the first month of the year, positive dialogue has also started on the India and US, which is actually the most important, or second, as important a trade partner as Europe, accounting for another 18% of the total merchandise exports. Right, so with this, as I was mentioning, India can look at bottom up. First, looking at government, government has been pro-growth, and that sort of continues. Balance sheet is strong when we look at foreign currency reserves, when we look at current account, when we look at fiscal cushioning, everything is in a good position. Coming to the health of the corporate India, we are also in a very good shape. Debt to GDP, debt to equity 1.6. And finally, with a lot of booster shots which have been given by the RBI and the government, both supply side and demand side, we think India is actually in a very good position to grow. Because finally, it comes back to the earnings. And earnings growth for India, this is projections that by Morgan Stanley for MSCI and MEPS, which had come down to 3%. That's actually starting to grow up. And we are expecting the earnings to revert to 11 to 12% in the last 1 year. So why is 3% that happened? If you don't remember, but I explained this on back in terms of the beta getting over, right? We had 35% PAT growth between 2021 and 2024. Because of that high base and normalization, the earnings growth came down to 3%. And from here, we are expecting a reversal back to the 10% range.
Shouldn't
10 and going back to mid-teens. But this is not without worries. They're both pluses and minuses. Pluses is that India is a domestic economy. We have a great demographic dividend, and what I just spoke about how government is looking at India. The minuses are obviously the geopolitical situation, which still remains a little uncertain because we don't know which side the US president gets up every day. What happens on that front, as well as AI is a big disruptor that is coming, that is disrupting a lot of industries, and what will be the implications? I think it's really still out, but I think those are some of the risks more global than domestic that one should be cognizant of when investing in India. But of these companies which will give you 11-12% return, there will be some companies which will definitely give you 15-20% return, and there will be some companies which will give you single-digit returns. And therefore, the year of execution, focus on micro as compared to macro, focus on earnings growth because earnings is eventually the holy grail of how the stock will do over the next few years. PE multiple is both a function of how the company is doing and also a bit of sentiment. Sentiment we can't control. The only thing which is under our control is earnings growth. So the focus has to be on earnings growth, and this is what we do at ICICI Prudential. We are a boutique within an institution, so we create boutique products for our clients. The core belief of our team is that it's companies that create wealth and not markets. While investing in the markets will make you 12-13% from a long-term perspective, it's actually investing in the right set of stocks over a period of time and sticking with them, right? Because markets tend to be volatile. One has to be in the equity for a long period of time, see through the volatility, and if you have the right collection of stocks in your portfolio, that will actually create wealth for a long period of time. In ICICI, we are uniquely positioned within the investor and boutique. We have a whole institutional where there are almost 20-member research team. We have very strong risk and compliance as well as a strong sales board. So this is how we are positioned at ICICI. So even this is some interesting data point that our team had put together. We have returns for the market for the last 50 years. So if you see even in any bad market like 2011 and 2020, 2012, which were almost the most weak periods when it came to fund returns, only 2% and -2%. There were still 80 companies, close to 80 companies, which gave more than 50% return, and that is what we are trying to achieve at ICICI Prudential in terms of getting the right selection of these stocks into the portfolio. The framework that we use is very simple: business management and valuation, no jargons, business as a just solid businesses which have strong economic moat, strong balance sheets, cash flow visibility. And this is all the more important now because the beta in the market has gone, as I explained sometime back. We are no longer in that 30-35% earnings growth. We are back to what we are 10-12% earnings growth for the market as a whole from here. Management, very important to back the right capital model where you short or where the capital is getting allocated. Because if you can't trust the people that your value, that's a big issue. And often capital misallocation happens at the time when there's a lot of capital flowing, which is the period right now. Finally, valuations are important. Growth without value and value without growth doesn't deliver results. So while we are growth oriented, have to be careful that we are taking reasonable multiples of the stocks that we are backing. So this is a simple framework that I, the strong institutional research that we have at ICICI. Finally, I just like to conclude. This is a period of execution. Beta as well as alpha, both the markets are challenging. There are some worries still on the global front in terms of geopolitics, in terms of AI. But when you look at how India is positioned, from a bottom-up perspective, strong demographic dividend, all the policies being very stable and growth related. I think India is in a good shape, and as where I started in terms of how India has done relative to the global equities, we've been a big underperformer. So this is a period of focusing on micro over macro, and with this, I just like to continue my allocation. Thank you very much.